Everyone's talking about JEPI, also known as JEPI, the ETF that pays you every single month with a highly attractive dividend yield. But is it a smart way to earn passive income in 2025? Or is there more risk than meets the eye? In this video, we're breaking down the real story behind JEPI, how it works, what the risks are, and whether it belongs in your portfolio this year. Let's get into it. JEPI stands for the JPMorgan Equity Premium Income ETF. It's designed to give investors monthly income by combining two things: large cap US stocks and a covered call strategy that generates extra cash flow. In short, you're trading some upside for more consistent payouts. As of early 2025, JEPI yields around 8 to 10% annually, and it pays out every single month. That sounds amazing, right? JEPI's top holdings include familiar blue-chip names like Microsoft, Visa, Home Depot, and Coca-Cola. And the expense ratio is 0.35%, which is a bit higher than a typical index fund, but reasonable given the added complexity of the option strategy. In 2024, JEPI returned around 7 to 8%, and most of that came from dividends. The share price stayed fairly flat, which is by design. Because JEPI uses covered calls, it gives up a lot of long-term price appreciation in exchange for short-term income. But there's a trade-off. It's also less volatile than the S&P 500. That makes it appealing to income-focused investors who want stability without giving up equity exposure. Here's where it gets interesting and a little risky. JEPI's net asset value has stayed mostly flat over the past few years, or even declined slightly at times. That's because the fund gives up growth in exchange for income. And during strong bull markets, like when tech stocks explode, JEPI tends to underperform. Its covered calls cap the upside. Another risk, the high yield isn't guaranteed. If market volatility drops or option premiums shrink, JEPI's income stream could fall too. Also keep in mind, JEPI's monthly dividends may be taxed as ordinary income if you're holding it in a taxable account. Make sure you understand the tax implications based on where you're investing. Bottom line, JEPI performs best in sideways or choppy markets. It's not built to thrive in big rallies. So, is JEPI a buy in 2025? Buy JEPI if you want. Monthly income, lower volatility, and a passive, low-effort strategy for cash flow. But avoid JEPI if you're looking for high growth, long-term capital appreciation, or a simpler strategy with fewer moving parts. JEPI is a powerful tool for passive income, but it's not a growth engine. Know what role it plays in your portfolio and you won't be disappointed. As always, this video is for educational purposes only. Always do your own research and consult with a financial advisor before making investment decisions. If you found this breakdown helpful, hit that like button so YouTube will show this to more beginner investors. It really helps small channels like mine grow. If you want to compare JEPI to other income ETFs, be sure to subscribe to the channel. We have more breakdowns coming soon, and if you're holding JEPI right now, I'd love to hear your take. Thanks for watching, and I'll see you in the next one.